Welcome to this lecture on financial technical analysis, focusing on moving averages. These powerful tools help us smooth price data, identify underlying trends, and filter out market noise. Moving averages are fundamental to technical analysis, providing a simple, transparent, and repeatable way to define trend direction and momentum without forecasting. First, let's explore the simple moving average, or SMA. The n-day SMA at time t is calculated as the arithmetic mean of the last n closing prices. A key property of the SMA is that it gives equal weighting to each of the last n observations. This means every price point within the chosen period contributes equally to the average. Larger n values result in greater lag, providing more smoothing but reacting slower to recent price changes. Common periods include 20-day for short-term, 50-day for intermediate, and 200-day for long-term analysis. Consider this numerical example for a 10-day SMA. If the last 10 closing prices sum to 1018, the SMA is 101.8. If the oldest value drops out and a new price of 110 comes in, the new SMA becomes 102.8. Now let's move to the exponential moving average, or EMA. The EMA applies exponentially decaying weights, giving more importance to recent data. This property means the EMA has less lag than the SMA for the same n, making it more responsive to current price action. It requires a seed. Typically, the first EMA equals the initial SMA. For a 10-day EMA, the alpha value is approximately 0.1818. If yesterday's EMA was 101.8 and today's closing price is 110, the current 10-day EMA would be approximately 103.3. Interpreting moving averages is straightforward. Price above a rising MA suggests an uptrend, while price below a falling MA indicates a downtrend. Crossovers between short-term and long-term MAs generate significant signals, indicating potential trend changes or continuations. Long-term MAs, such as the 200-day, often act as dynamic support or resistance levels. One of the most recognized signals is the golden cross, a bullish indicator occurring when a short-term moving average, typically the 50-day, crosses above a long-term moving average, like the 200-day. This signal is often interpreted as a transition from a downtrend to an uptrend, suggesting potential for significant price appreciation. Conversely, the death cross is a bearish signal, where a short-term moving average crosses below a long-term moving average. This often signifies a transition from an uptrend to a downtrend. For both golden and death crosses, volume expansion at the time of the crossover can confirm the signal's strength. Broad market indices tend to produce fewer whipsaws than individual volatile stocks. Moving averages offer several strengths. They filter out market noise, help align traders with the primary trend, and their simple, transparent rules make them easy to backtest and teach. They are also widely followed, which can lead to self-reinforcing behavior at major crossovers, enhancing their predictive power. However, moving averages are lagging indicators, meaning signals often appear after a significant portion of a price move has already occurred. They are also vulnerable to whipsaws in range-bound or highly volatile markets. Additionally, their effectiveness can be sensitive to the chosen parameters, with different assets potentially requiring different look-back periods for optimal performance. For practical guidance, use shorter-term moving averages for identifying entry and exit points, while longer-term MAs are better for defining the overall trend and market regime. Always align your moving average strategies with sound risk management principles. For instance, placing stop losses below a long-term MA in an uptrend can help protect capital. Consider combining moving averages with other indicators, such as momentum or volume, to reduce false signals and confirm trend strength. Thank you for joining this lecture on moving averages. We hope this foundational understanding will aid your journey in financial technical analysis.